What's going on, guys? Tonight, I'm going to explain to you what a fair value gap is. I know we have a lot of people that are brand new to trading that have recently found my channel, and sometimes they don't know what a fair value gap is. We've covered already what the opening range break is. You can find that in previous videos, but I pair my strategy that I use daily as the opening range break with a fair value gap. So you may be asking, what is a fair value gap? I'm brand new. I have no idea. So let me explain it to you. The fair value gap is a simple three candle pattern. It basically shows you where the market moves so fast that it left behind an imbalance or a liquidity zone, if you want to call it that. When you combine fair value gaps with an opening range break strategy, you can see where the market is trending based on where the institutions are dictating where the money goes. So, again, a fair value gap forms when the market moves so fast and so aggressive that it essentially creates a zone where minimal counter trade activity has happened. So if it's going bullish and there's a lot of buys, there were no sells during that period, which leaves behind an imbalance or a liquidity zone. It's essentially just a gap that the market skipped over. Eventually, at some point during the day, the market typically returns to it and it fills in these imbalances. But if one remains for a long time, it's a good indicator of which way the market's heading. So follow along here with me. You have candle one, you have candle two, and you have candle three. You need the three candle pattern to create a fair value gap. So candle one sets up the move. Candle two, you would pretty much call the impulse candle. It's the big mover, and it's usually 2 to 5 times larger than the surrounding candles. But for ease of visuals, I left them about the same. And then candle three continues the move in that direction. So is how this works is you take candle one and you look at the top wick, which is right here. So you have the top wick of candle one crossing and overlapping with the body of candle two. Then if you look at the bottom wick of candle three, it's also overlapping with the body. So where it overlaps with the body from the bottom of this wick to the top of this wick, there was no activity from sellers in this gap. It would be the other way reversed. If these were red and we were going down, there would be no activity from buyers in this gap. So is how you would mark this out is you would take your rectangle tool and you would have the top wick of candle one and you would stretch it over to the bottom wick of candle three. This gap right here is called a fair value gap. And again, it's an imbalance. It's a liquidity zone. So there was no selling activity strong enough during this time to push down into this gap. And it was moved so fast by institutions that there's liquidity sitting right here. They pushed it so quick up through this zone and then it never recaptured. So this would indicate, even though I made it red, just for clarity of seeing the visuals, that buyers are in control and sellers were not strong enough right here to reclaim any of this. So the sentiment is going to be bullish. So now let me show you how you would pair that with the opening range break and how you use it to know that it's going in the direction that you're seeing on the chart, being today bullish. This then leads right into my opening range break off of the 5-minute candle. So you want to be on the 5-minute chart. And then I actually have this key levels indicator on right here, which automatically marks the opening range break for me on the first 5-minute candle. All you would need to do is download this. It looks like this right here. It's key levels by Liquid Trader. You add that to your chart and you come into the settings, which is this little icon right here. And you would then click, I'll uncheck that box so it's not all crazy. Opening range, you would uncheck all these other ones that are already checked. Just have opening range and put 5 and then scroll all the way down to the bottom and make sure that your time frame is set for New York open at 9:30. Then when the first 5 minutes close, it will automatically mark your opening range. You don't even need the rectangle tool. You don't need to draw it yourself. It does it on its own. So once this candle has closed, you have your opening range break that you're looking for your fair value gap on. Now, here's my drawing from earlier, but I'll show you on the chart for today. This is November 13th of how perfect this would have worked out. I was actually doing a live at the time working on a different strategy, so I completely missed this. So I did not actually take this trade, but it is the perfect setup. So this bottom line and this top line is your opening range break from your 5-minute candle. You're waiting for a candle to break outside of the opening range break on your 5-minute candle you have marked here and here. So you can see buyers are in control here. We get a fair value gap. That's what this is. That's also an indicator I have. Lux Algo fair value gap. So you don't need to draw this yourself. You just need to download this indicator. And when a fair value gap presents itself, it's there. I mainly wanted to show you guys earlier in the video how you would do it yourself if you needed to know how. And Top Step, for example, doesn't have a fair value gap indicator. You have to find them yourself or pair TradingView on a different screen so you can see when they present themselves. But this is exactly what I look for. Fair value gap here, and we break outside of the zone. Now, I would probably wait for this candle to close because I want one candle to close outside of my opening range. Once that closes, I move on to the next candle. And right here, it's immediately not reclaiming this. So my position would have been I went in right here because even though the fair value gaps are in the zone, they were never reclaimed. So I would have entered right here on this candle, and then you would have your stop loss about midway through the zone. That would be at 84 points. And then you want to target a 1 to 2 risk to reward. So let's just say 84 times 2. I'm not going to get exact. I would if I were in the trade, but somewhere in. So I would have entered right here because I broke out of my opening range break. I have two fair value gaps that were never reclaimed, and the market is still moving in that direction. So when I went right here, that would have been about 938. And then over here at 954, about 16 minutes later, I would have had my take profit hit, which would have been I risk $500. So I was willing to lose 500 to make 1,000. So in 16 minutes, I would have went from entry to done, and I would have been up $1,000. And I'm on the West Coast, and it wouldn't even have been 7 a.m. in the morning, and I would have already been done for the day. You also can see how if you were to zoom out, this fair value gap structure really pushed, and you could have went way higher today. Like you could just trailed your take profit up. I mean, just didn't stop today. We got all the way up to 25,260. So if you were way up here, you would have been looking at a 1 to 5, almost a 1 to 6 if you would have just trailed it up and let it run and just stuck with it. So you could have done either of these. You could have had a 1 to 2, or you potentially could have had a 1 to 5. So that right there is what a fair value gap is. That's also exactly how I use it on my opening range break strategy that I have used for all of 2025. It's one of the easiest and most simple patterns and strategies that you can use if you just simply know how to identify it. I hope this helps. We'll see you guys on the next one.